The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Scorebox Europe. I'm Steve Sedgwick with Karen Cho and, of course, Juliana Tattlebaum. Following events in Geneva, those dramatic events, these are your headlines.
The U.S. and China reach a trade deal, both sides cutting their tariff rate by 115 percentage points in a bid to de-escalate tensions.
We concluded that we have shared interest, and we both have an interest in balanced trade. The U.S. will continue moving towards that.
Shares in Europe's China-exposed companies surge, with stocks across the luxury, autos, freight and tech sectors leading gains.
However, European pharma stocks diving after the president, Mr. Trump, vows to sign an executive order slashing drug prices for Americans by as much as 80%. Well, unanimous reaction this morning, and it is positive, really, to the news out of Geneva that the US and China have agreed to cut tariffs for 90 days. Beijing will reduce duties to 10% from 125%. The White House will bring down duties from 145% to 30% on Chinese goods. Markets are rallying on the news. European equities, as well as US futures, trading solidly in the green. Juliana joins us more. Juliana, I'll say it for our American audience who are joining us now, but I think everybody thought, yes, there were going to be platitudes, but actually the substantial news we're getting about actual action to de-escalate, I couldn't have expected anything more positive this morning.
Steve, you're absolutely right. I think markets were bracing for a de-escalation, especially after President Trump posted on Truth Social on Friday that 80% sounded like the right level for tariffs. And we got so much more than that this morning. And that's why you're seeing an extraordinary positive reaction in markets. So here's what we have. The two sides have agreed to a 90-day pause, as you said, and to substantially move down the tariff level on both sides, 115% reduction on both the Chinese and the U.S. side. And importantly, as Treasury Secretary Scott Bessent said, they've also agreed a mechanism for continued talks. So what happens beyond the 90 days, that's going to be a function of the talks that take place over the next 90 days. And he said there's now a mechanism in place for that, addressing market concern that the U.S. didn't necessarily have a plan when it posted that now infamous board on the White House lawn on April 2nd. He said they've had a plan, they have a process in place, and now they have a mechanism. Take a listen to what the Treasury Secretary had to say and how he characterized the conclusion of the talks this weekend.
We have reached an agreement on a 90-day pause and substantially moved down the tariff levels. Both sides on the reciprocal tariffs will move their tariffs down 115%. We had very robust discussions. Both sides showed great respect. It was a chance for me to meet the Chinese delegation. The vice premier I had previously had only a video call with. Ambassador Jameson was familiar with two of the other leaders on the delegation from his previous time. So there was very good personal interaction. Both countries represented their national interests very well. We concluded that we have shared interest, and we both have an interest in balanced trade. The U.S. will continue moving towards that.
Now, when asked during the Q&A part of the press conference, Treasury Secretary Scott Bessent about the 90 days and what they need to see in those 90 days not to see an escalation once again on the tariff front. And he said, as long as there is constructive dialogue, we will keep moving forward. So it was just positive after positive in terms of news flow for the markets this morning. Looking at one analyst in particular, Dan Ives from Wedbush, he came out this morning just moments ago with a fresh research note saying this is a best case scenario for the market, a dream scenario. He said we were expecting a de-escalation given the encouraging rhetoric that we heard from both sides toward the end of last week, and given simply the fact that they'd agreed to meet this weekend in the first place. But what we got was so much more than that, and the market reaction matches.
Juliana, yes, to your point, given that Trump was talking about 80% going into the weekend, we're far and away below that level. I think the market now resetting, and as a result, those moves off the sidelines back into equity markets. A lot of commentators are talking about that. I saw one tone suggesting reverse Liberation Day. The markets you can see bouncing, and so far it is mainly the European markets, the DAX, where you're seeing gains across to the French market and Italy, very strong today. But what has been somewhat of a tug of war has been the resources stocks versus pharma for the FTSE, which is keeping it trapped in a range. Some of the negativity is still to come, potentially around drug pricing in the US. So that is impacting the FTSE's fortunes. But to some of the best performers, let's just drill down. A really obvious plays here, shipping logistics. You're seeing that through some areas of the market, resources as well. So basic resources up close to 5%. Autos, big car makers have been twisting and turning around the various different tariffs, components as well. And all those players you can see bouncing aggressively. Technology is strong, oil and gas as well. Now, some of the worst performers where we're seeing some of that pain trade still come through the system today, it is healthcare names, a big pharma trade that is still yet to come around drug pricing, utilities, real estate, telecoms, some of the defensive areas of the market that have been benefiting of late. I would say you are seeing left somewhat behind in the trade today. They're either being sold off or they are fairly flat versus the gains you're seeing elsewhere. To the autos, and what we're witnessing here in that space, Volkswagen strong, but it is a BMW, Mercedes, some of the big, strong luxury names, those big badged cars are seeing the best performance today. To the mining stocks, some of the big cyclical trades, Glencore was very strong out of the gates, up 6%. Some of the trades, I would say, giving back some of the high end that they've been seeing this morning, not holding on to all of the upside, but you can see resources still very, very strong. Luxury plays, it has been very torturous for these names. It has been one knockout after the next. The consumption story out of China that has been so weak, to the US market, the American customer being impacted by tariffs and some of the uncertainty. But this morning, very strong, 5% up on a lot of these key names. Big chip stocks. The technology play this morning is around these big semiconductors, and you can see right across to AMS, Osram, ST Micro, all stronger today. And the oil majors are seeing a bit of a pop around with the price, but it's BP up 2.2% and 2.5% on Total. That is the best of it on those charts. To US futures, we are expecting that reaction stateside as well. They were already leaning positive after the weekend, but with the news flow that hit the tape at 8 o'clock local time this morning, you can see really ramping up, and 800 odd points up on the Dow. So we're anticipating a very strong trade there to the NASDAQ, seeing up 650 odd points, Steve.
Karen, our timing is perfect with our next guest. It's Ben Chu, who is author of Exile Economics, What Happens When Globalization Fails. And Ben, of course, you are a journalist at the BBC as well, and it's a mighty time. I'll hold it up just so the viewers can see. It's Exile Economics, and it's out on Thursday?
That's correct, yes.
Well, look, I never approached the subject without thinking of my late, great lecturer, Paul Hurst, who questioned the whole nature of globalization and what forces were driving it and what forces were in place before it as well. But more importantly, may I just spin forward to today and ask you what we've learned about globalization today from the extraordinary events in Geneva?
Well, I think what we've learned today is that it's quite a resilient beast in some ways, because we wouldn't have expected that Donald Trump would de-escalate quite so rapidly. But I think the desire to do that is the fact that the impact on supply chains, on the impact on prices of things coming into the United States, the sheer availability of things coming into the United States from China, we've started to see that very, very rapidly. That shows you how reliant the US is on imports, particularly from China. And I think that's given, it's been a wake-up call, in effect. And I think that lies behind the desire to tone this down, de-escalate. And I think that's why you've seen it and why the market's obviously very pleased to see it today. Whether it will last or not is another question.
Ben, it's too simplistic to say globalization works, globalization doesn't work. And again, I bow to another great lecture on this, and Richard Koo as well from the Muir Institute. There's some brilliant things on this. And the fact of the matter is, globalization can be working and not working at the same time. It can work beautifully for TNCs, the transnational corporations, the big companies and their shareholders. It can work beautifully for billionaire investors on both sides of the Pacific. But it might not necessarily be working for your average American, your median and low-income salaried Americans as well. And that's the point about it, isn't it? It's working and not working at the same time.
I think economists have always recognised that there are impacts of trade which are uneven on a particular economy, on a particular society. Overall, they think the gains are there and are large and have been large for many decades. But some communities do feel the downside. For instance, if you're competing with a sector which suddenly starts importing a lot of goods or outsources or moves its operations abroad, those impacts are real and have to be addressed. I think what economists would say is the failure is not of globalization per se. It's the failure of domestic politicians and economies and societies to redistribute those gains and give the losers, if you like, the concentrated losers in certain communities, the ability to win.
Just to summarise then, my word's not yours, but I wonder if you'll endorse it. There are certain parts of America that are cleaning up on globalisation, but the broader population isn't.
I think the broader population has done pretty well. I think that's what all the economic studies show of globalisation. But there are pockets of America in the Rust Belt. I mean, there's iconic examples of, say, furniture makers in North Carolina who've been really hit by what they call the China shock of importers bringing in furniture rather than producing it in America. So there are pockets of places which have done badly, and that has been well documented. But the ability of the American state to have mitigated that was quite large. And I think the critique is from a lot of economists that they didn't do enough. And you are seeing some level of backlash against that. But it's important to underscore that overall, most Americans have done pretty well out of globalization in terms of the prices coming down, in terms of the availability of goods coming in, and also the ability for them to specialize in what they do best, which is increasingly services. And those services jobs have a higher income than they would, for instance, in producing steel or producing furniture or producing textiles, as another iconic example of something which is production has shifted as a result of globalisation.
To your point, it really tests the rhetoric or what we had in terms of knowledge around globalisation for many decades, which is that developing nations did particularly well in these poor developing countries. Developing nations were putting ingredients on ships and not really getting the upside of developed products. But now, as we go back to discussion of how much steel do we all want, it sort of goes back to we take a view of the entire supply chain again. How much steel does the US need if it's bringing manufacturing back? How much steel does Europe need if it's bringing manufacturing back? What is the importance of some of these raw materials that we'd really discarded as being relevant in a globalized economy?
Well, I talk a lot about steel in my new book, and it's really what it's regarded, isn't it, as the litmus test of a society, of an economy. If we're able to produce primary products like steel, if we don't have that, there's something deficient in our economy and we're very vulnerable. Donald Trump is very explicit about that. He's saying if you don't have steel, you don't have a country. Well, the reality is, if you look at it, there's quite a few developed, rich countries which don't produce a lot of steel. Think of Ireland, think of Denmark, think of Norway, think of Israel, for example. They don't produce steel, they import it, and yet they're rich, prosperous, and secure on the whole. So I think the issue with things like steel, which have this really iconic image, is that sometimes the reality is not the same as the image. If every country wanted to produce steel and decided to produce steel, you'd have what we have now, but even worse, which is a huge oversupply of the global market for steel. And that pushes down prices, it creates instability and fears of steel being dumped, and it encourages people to produce yet more and put up trade barriers. We need to think that in terms of a global economy when it comes to these primary products like steel.
So what is the connection here, as Bessent was talking about more precision manufacturing coming back to the United States? Because you've got to think, well, Europe is going to possibly be thinking the same way at some stage around precision manufacturing, which has been done in China, it's been done in Taiwan. If that comes back to the US and if it comes back to Europe eventually, what sort of industries need to be built out to support precision manufacturing?
Well, it's a good question, and it's very interesting that the emphasis on precision rather than simply manufacturing, which is the sort of thing that Donald Trump has been talking about. And you remember Howard Lutnick, the Commerce Secretary, stressed maybe things like textiles and iPhones would come back to the United States. I think the future of manufacturing in developed countries like the US, like the European Union, like the UK, is in precisely that high-tech style of manufacturing, which can't be done as easily in other countries, and where we can really add value through robotics and through our science base.
It's a robotic arm these days, isn't it? That's what precision manufacturing looks like. It's something you see at all the tech shows. It's not a person there screwing in tiny components.
And that is the realistic future for manufacturing in developed countries. It's not mass manufacturing of things like steel and screwing in assembly of iPhones and making textiles again. It's much better, much more rational for that kind of production to be done in developing countries. So in terms of what sectors need to be around in developed countries to make that happen, well, it really is about the science base. It's about investment in those high-tech factories with those robotic arms. And it's a very different focus from simply let's put a tariff up and let's bring in all those relatively low value-added manufacturing jobs back to the US or the UK or Europe or wherever.
Ben, we've given everything you've said and you've written about and you've observed as well. Let's say there's a deal. Let's say there is a deal in the next 90 days. I fully expect it, given the rapprochement that's going on now as well. What does a medium-term win look like for both sides as well? Because in the short term, they'll say we've got a deal, we're addressing the balance, but we all know full well that the US trade deficit with China is not going to disappear as well. What does it look like in the medium term? And what does that mean about your existential question about globalization? Is it going to fail?
Well, I think we should bear in mind that this is a pause. It's not a full deal yet. And that's pretty important because that brings a lot of uncertainty, of course. The markets are up today, but they don't know whether these tariffs will be gone or reduced to this level forever or whether they could come back. Donald Trump has promised other tariffs on pharmaceuticals, on semiconductors. So I don't think this is over yet. And I think if you just look at the deal of the UK-US agreement, that included certain lines and clauses about working together to keep effectively China out of their market. So I don't think that the desire of Donald Trump and the American administration to decouple from China is entirely gone yet. And I don't think they've entirely made up their mind about their strategy. They obviously want to reduce and de-escalate to some extent now, but the longer term goal, I think, still might be to pause.
Over. And it was, the words were, the embargo is over, it was unsustainable.
Mm-hmm. Yeah, well, I think there's certain people like Bessent in the administration may believe that. Whether everyone in the administration believes that, whether Donald Trump believes that, I think is still open to question. Don't forget these other reciprocal tariffs, not just on China, but on the rest of the world. They are still hanging over the global economy as well. And I think while that remains, and while there is that fundamental uncertainty about what Donald Trump is trying to achieve with trade, don't forget he's relying on a lot of those revenues to offset the cost of tax cuts. He still wants to reindustrialize America, and tariffs are his main tool to do that. While there is that conflict in what he wants to achieve and that uncertainty about how he is going to go about achieving it, I think that will hang as a serious pall over the global economy.
Ben, big question and limited amount of time, but very quickly, what do you expect on Big Pharma? Because the negotiating point has been raise prices in Europe as the Americans are talking about getting the most favoured nation, the cheapest price in the world. Where does Pharma end up?
Well, I think that's a very complex question. I mean, Donald Trump tried something like this in his first term, and there was a strong legal challenge to it. And in terms of the impact on the pharma companies, well, they make a lot of their money in large developed markets like the US. So the impact on their share price, if this was actually enacted as described, would one imagine be quite severe. But I'd be a bit skeptical about assuming that it would definitely happen in the way that he's described in his Truth Social posts, because it's a lot more complex than that, and there will undoubtedly be a lot of lobbying of him by those influential and powerful pharma companies to introduce a different scheme. So how it will shake out is unclear, but very profound potential implications, no doubt.
Ben, thank you so much for joining us on what is a big trade day, so we do appreciate your expertise. Ben Shu with us, author, Exile Economics. What happens when globalization fails? A look at how US futures are perched as we head towards break. Big response expected stateside. Risk on trade at this early hour, as you can see, coming into force very early on, right across all three major indices. The Chinese and Americans did more than just talk, and the result of the de-escalation that we're seeing in those reciprocal tariffs really moving the needle on markets here in Europe this morning. You can see a big broad-based bounce across some resource stocks, about 5% up on some names. Luxury benefiting as the reading is on the strength of the US and Chinese consumer. Technology out in front, and of course those big shipping stocks certainly getting a big bump up today. Maersk in particular has been right towards the top of the benchmark, the stock strip 600.
Yeah, interesting. A lot of stocks in negative territory, not just the farmers though. Anyway, let's move on. UniCredit posted its best quarter in history and raised expectations for the year ahead. First quarter profits surged 8.3% to 2.8 billion euros, surpassing expectations. The bank now expects full year net profit to come in above 9.3 billion euros. Sylvia, where's the interest in these numbers? Is it the numbers or is it the continuing speculation about what happens next in Germany?
I would say everything. I care about everything. Thinking about the numbers, they are astonishing, really. UniCredit beating both bottom and top line. Both top and bottom lines, I should say, in terms of their latest results. Thinking about net income, it came in at 2.8 billion euros, and that was against 2.4 billion expected. As a result of this very strong quarter, UniCredit also raising the full year guidance, so another positive there for investors. At this stage, we are seeing shares of UniCredit actually moving higher this morning. We know that the overall market sentiment is quite positive this morning, but nonetheless, still important to look at UniCredit shares on their own. And ultimately, though, this is the message from Andrea Orcel on the earnings today.
Fundamentally, we were able to compensate the planned decline of NII with much increased fees, further boosted by client trading, which got our revenues to be much higher than we expected in the quarter. We continue to have a firm grip on cost. On same perimeter, we're down 1.3%. Our cost of risk is still mild at 8 basis points, which is quite low for banks. And that, together with a very efficient use of capital, allowed us to deliver a 22% return on tangible for the quarter and increase profit by 8%. Most importantly, all of that leads us to increase our excess capital from 6.5 billion to 10.
But we can't discuss UniCredit without discussing potential consolidation here. We know that they have made bids for BPM in Italy as well as Commerzbank in Germany. And here the question mark at this stage is whether Andrea Orcel will be in a position to actually move forward with these two deals. Andrea Orcel told us this morning that he's still thinking about what to do in relation to BPM. And at the same time, I also asked him whether the latest results from Commerzbank made it increasingly harder for him to go ahead with that potential deal. And he actually still said that he has doubts about the core performance for Commerzbank. Let's take a look.
We have inorganic possibilities in every one of our 13 markets, in every business. It is our duty to look at every one of them and to try to capture the ones that are positive. We've also been very clear that we would not execute if it wasn't in the best interest of our shareholders. As you know, we have a base case, standalone base case, that I think is unbeatable in the next 3 years, from a distribution standpoint and from an EPS growth standpoint. So we're not going to affect that negatively for anything, and much less on M&A pushed by the pressure that always builds up when you get at this point. But at this point, I think we are in control. On BPM, we are reviewing the situation, post the value destructive deal on Anima and the demands of the Golden Power, and we haven't made up our mind yet. On Commerzbank, we're exactly where we thought we would be. We announced about 10% when we bought almost half of that amount from the German government in an orderly, transparent process. We've always kept Commerzbank informed from the beginning, and even before we bought that stake.
Andrea Orchel there, that comment around the pressure, making it very clear that there is pressure on this bank at this stage, as we are seeing a lot of players really trying to play a role in this potential consolidation. At home, the Italian government has made it harder for UniCredit at this stage to move ahead with BPM. They have asked for a lot of feedback on certain issues, such as when they might be able to exit the Russian market. On top of that, a lot of question marks still when it comes to Commerzbank. And in that interview, Andrea Orchel saying that they had no conversations as of yet with the new German government. So at this stage, guys, these two potential deals very much at the open, really. We don't know whether he will manage to go ahead with them or not.